This AI-generated podcast is for general information only and does not constitute financial or legal advice. Listeners should independently verify all information. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris. This show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 8 June 2026.
So today we are doing a deep dive into a highly technical and, frankly, heavily scrutinized area of European finance.
Yes, we are.
We are talking about ongoing third-party payments. If you manage private client portfolios or structured distribution channels, you know exactly what we are focusing on today.
Right, the regulatory parameters surrounding these continuous payments.
Exactly. So to set the foundation immediately, our primary thesis for this deep dive is that trailer fees under the Luxembourg regulatory framework are a specific subset of MiFID II inducements that are strictly governed by service classification, requiring mandatory transparency, quality enhancement, and uncompromising alignment with client interests.
That is the core premise. And to execute this legal masterclass for you, we have structured a strict clinical agenda focusing on exactly 3 core takeaways.
Right. Let us hear them.
Takeaway 1 will examine the precise legal distinction between general inducements and specific trailer fees. Takeaway 2 will detail the strict 2-part admissibility test for retaining these fees.
Okay.
And finally, Takeaway 3 will address the absolute prohibition on retaining trailer fees for independent investment advice and portfolio management, alongside the strict disclosure mandates.
Perfect. So let us just jump straight into takeaway 1, defining exactly what constitutes a trailer fee versus the broader category of inducements. But before we map out those operational boundaries, what are the foundational legal texts we are actually working from today?
Well, to establish this correctly, we must first cite the governing legislation. The foundational text in this jurisdiction is the Luxembourg Law of 5 April 1993 on the financial sector.
Okay, got it.
For our ongoing analysis, we will refer to this as the 1993 Financial Sector Law.
Right, and at the European level.
The overarching European framework dictating these rules is Directive 2014-65 EU of the European Parliament and of the Council of 15 May 2014 on markets in financial instruments. Going forward, we will refer to this simply as the 2014 MiFID II Directive.
Okay, let us unpack this then. In practical terms, the framework covers fees, commissions, and monetary or non-monetary benefits.
Yes, it does.
But is every single inducement automatically classified as a trailer fee under the 2014 MiFID II Directive? And if not, where exactly is the legal boundary drawn? Because the terminology in this area can get a bit imprecise.
That is a critical distinction to make right away. The inducement framework is the broader operational category.
Right.
It captures any fee, commission, or monetary or non-monetary benefit received from or paid to a third party in connection with providing an investment service or an ancillary service to a client.
So it is a very wide net.
Exactly. A trailer fee, on the other hand, is simply a specific, highly regulated type of inducement that sits within that broad framework.
Could you provide the operational mechanism for that specific type then? I mean, what does a trailer fee actually look like in procedural terms?
Sure. A trailer fee operates as a retrocession of commissions to a distributor of financial products.
Okay, so a retrocession.
Right. In a private banking context, for example, it is typically an ongoing commission paid by a product manufacturer, like a fund manager, or a financial product provider to a bank, a distributor, or an intermediary.
So the manufacturer pays the distributor?
Yes. And the key characteristic here is the duration. This payment continues for as long as the client remains invested in the product.
Ah, okay. So it is not a one-off transaction. We are talking about an ongoing third-party payment linked directly to an investment service where a fraction of the capital is retroceded continuously.
Correct. And because of that direct ongoing linkage, it automatically falls within the inducement rules.
Which inherently raises the question of conflict of interest, right?
Exactly. The regulator recognizes that structural dynamic. To cite the legal anchors here, this legal distinction is governed explicitly by Article 37-3, Paragraph 3- of the 1993 Financial Sector Law.
Okay.
And it operates under the parameters of Article 24-9 of the 2014 MiFID II Directive.
So the practical reality for any compliance officer listening is quite clear.
Yes, it is. All trailer fees fall within the inducement framework, but not every inducement qualifies as a trailer fee.
Right, because if an institution receives, say, a one-time placement fee...
That is an inducement, yes.
Yeah.
But it is not a trailer fee because it completely lacks that ongoing trailing characteristic.
Okay, that makes perfect sense. So to wrap up this first section, this confirms that trailer fees under the Luxembourg regulatory framework are a specific subset of MiFID II inducements that are strictly governed by service classification, requiring mandatory transparency, quality enhancement, and uncompromising alignment with client interests.
Precisely. That is the fundamental boundary.
Which brings us to the operational reality of how these fees are handled. If these ongoing payments create a structural conflict of interest, how is it legally permissible for institutions to retain them at all?
Well, retention is not a given.
Right. What specific procedural criteria must an institution actually satisfy to retain these fees without falling into compliance nonconformity? This transitions us directly to takeaway 2, I believe.
It does. Takeaway 2 covers the regulatory conditions required to legitimately retain a trailer fee. And as I said, the retention of a trailer fee by an institution is strictly conditional. It is never, under any circumstances, automatic.
Okay, so what is the procedure?
To proceed without operational gaps, an institution must pass a strict 2-part admissibility test.
Let us hear Condition 1.
Condition 1 requires that the fee must be explicitly designed to enhance the quality of the service provided to the client.
And Condition 2?
Condition 2 requires that the fee must not impair compliance with the professional duty to act honestly, fairly, and professionally in accordance with the client's best interests.
Hold on, let us examine that first point clinically. Someone looking at this framework might see the quality enhancement condition and assume it is just a procedural technicality. I mean, how difficult is it for an institution to simply state they are enhancing service to justify the retention of that revenue stream?
Well, it is actually the opposite of a procedural technicality. It is a rigid operational hurdle.
How so?
You cannot simply provide standard baseline investment advice and claim that the retained fee enhances it. The institution must demonstrate tangible proportional value added for the client.
Can you give an example of what qualifies as tangible value?
Yes. The retention of the fee might be justified if the institution uses it to provide access to an exceptionally wide range of financial instruments, including an appropriate number of third-party products.
Okay, so broader market access.
Right. Or it could be justified by the provision of continuous value-added tools. Think of objective information tools or regular comprehensive performance reporting that goes significantly beyond the standard regulatory minimums.
So the enhancement has to be real, documented, and proportional to the inducement received.
Exactly.
Okay, but what about the second condition? The requirement to not impair the duty to act in the client's best interests. How does a firm practically prove that their advice is not impaired?
By maintaining highly robust internal governance. The institution must prove that the receipt of the trailer fee does not bias their recommendations. So, if a bank consistently recommends a suboptimal in-house fund simply because it pays a higher retrocession than a better-performing third-party fund, they are completely failing this condition.
Right, because the bias is evident.
Exactly. Their product selection process must be demonstrably independent of any revenue-sharing arrangements.
Okay, so let us say an institution successfully satisfies those two conditions. They prove they are offering premium tools, and their recommendations remain entirely unbiased. Is retention automatically permitted at that specific point?
It is not. Transparency mandates act as the final mandatory procedural requirement.
So they have to disclose it?
Yes. Prior disclosure is legally required. The institution must inform the client of the fee's existence, its nature, and its exact amount, or the specific calculation method, before providing the relevant investment service.
Before the service is provided?
Yes. Prior disclosure is non-negotiable.
And which legislative text introduces this specific transparency mandate?
This procedural rigor is governed by Commission Delegated Directive EU 2017-593 of 7 April 2016.
Okay.
We will refer to this framework as the 2016 Delegated Directive. Specifically, the admissibility conditions and transparency obligations we just broke down are anchored in Articles 11 and 12 of the 2016 Delegated Directive.
Articles 11 and 12 of the 2016 Delegated Directive. So the technical structure of those articles ensures that these fees cannot be retained passively. They remain closely regulated.
Precisely. The 2-part admissibility test acts as the operational filter. Only fees that pass through that filter can be legitimately retained.
which confirms our position again. Trailer fees under the Luxembourg regulatory framework are a specific subset of MiFID II inducements that are strictly governed by service classification, requiring mandatory transparency, quality enhancement, and uncompromising alignment with client interests.
Exactly. That thesis holds firm.
Good. So we now move to takeaway 3.
Yeah.
We are transitioning from the general admissibility conditions to the specific service scenarios where those standard conditions are overridden by absolute prohibitions.
Yes. This is where service classification becomes paramount.
Right. So if service classification acts as the ultimate determining factor, how do the rules apply to distinct operational models specifically? Independent investment advice or portfolio management?
Well, service classification completely alters the permissible operational parameters. The admissibility test we just discussed applies primarily to non-independent advice, or the general reception and transmission of orders.
Okay, but for independent advice?
For independent investment advice and portfolio management, the institution may not accept and retain fees, commissions, or any monetary benefits paid by third parties. It is an absolute prohibition.
An absolute prohibition. Let us break down procedurally why that is the case. If a professional explicitly markets their service as independent investment advice, the core value proposition to the client is absolute objectivity, correct?
Correct.
And if you are engaged in portfolio management, you possess discretionary authority to make trades on the client's behalf.
Exactly. You are making the decisions for them.
So in both of those operational scenarios, allowing the advisor to keep a continuous third-party fee would fundamentally fracture the fiduciary alignment.
That is the exact regulatory rationale. The regulations recognize that in discretionary portfolio management and independent advice, the risk of bias is simply too high to be mitigated by disclosure or quality enhancement.
So it cannot just be disclosed away.
No, it cannot. Therefore, the retention of the fee is strictly banned. For independent investment advice, this strict requirement results directly from Article 37-3, Paragraph 3-B of the 1993 Financial Sector Law.
And what about for portfolio management?
For portfolio management, the prohibition results from Article 37-3, Paragraph 3-C of the 1993 Financial Sector Law.
Okay, wait. Practically speaking, what is the required procedural action if such monetary benefits are somehow received during the execution of those specific services?
What do you mean?
I mean, if a client is in a discretionary portfolio management mandate and the underlying fund automatically pays out a retrocession to the bank,
Right.
The money physically arrives at the institution. What actually happens to it? Is it transferred to the state? Does the institution send it back to the fund manager?
No. Any monetary benefits received must be transferred in full to the client.
Transferred to the client.
Yes. The rules are structured to reduce conflicts of interest and protect the client's financial position. Procedurally, the institution must allocate those received funds directly to the client.
How is that usually executed?
This is usually executed by crediting the client's cash account or by offsetting the amount against the direct advisory or management fees the client owes to the institution.
Okay, so the institution is acting merely as a pass-through entity for that specific revenue.
Exactly. They cannot retain a single euro of it.
That is a highly specific operational requirement. But what about non-monetary perks? If monetary payments are strictly forbidden or must be passed through entirely, are there exemptions for non-monetary benefits?
Yes, there is a permitted exception for minor non-monetary benefits.
Okay.
For example, items such as information documents or technical training on the features and risks of financial products remain permitted. And that applies even for independent advisors and portfolio managers.
But they must still meet the baseline conditions, surely.
Of course. They must be capable of enhancing the quality of the service provided to the client. And critically, they must not impair compliance with the professional duty to act in the client's best interests.
So a highly technical seminar on a complex fixed income product would qualify because it enhances the advisor's ability to actually serve the client.
Precisely. It is about technical competence, not commercial reward.
Right. Now, beyond the prior disclosure we discussed earlier for non-independent models, what are the ongoing reporting obligations for any legally permitted trailer fees?
The obligations are continuous.
So if an institution is operating a non-independent advisory model, they have passed the admissibility test, they've provided a prior disclosure, and they are legally retaining the trailer fees. They do not just file the paperwork away and forget about it, right?
Not at all. Annual reporting applies strictly to ongoing trailer fees.
Okay. What does the regulation say exactly?
Article 11-5-C of the 2016 Delegated Directive requires annual disclosure on an individual basis of the actual amount of payments or benefits received or paid.
So a specific itemized amount.
Yes. It is not enough to simply tell the client up front that you will receive a percentage. Every single year, you must provide the client with a precise accounting of exactly how much money you receive from third parties in relation to their specific portfolio.
Wow. Okay. So admissibility, prior disclosure, and this strict annual reporting must remain completely consistent throughout the entire lifespan of the client relationship.
Yes, there could be no procedural discrepancies year over year.
That ensures the client is constantly reminded of the commercial realities of their investment structure. It allows them to evaluate year over year if the service they're receiving actually justifies the indirect costs they are paying.
Exactly. And when reviewing the cumulative effect of the service prohibitions, the admissibility tests, and the annual reporting mandates, the conclusion is precise.
It certainly is.
Trailer fees under the Luxembourg regulatory framework are a specific subset of MiFID II inducements that are strictly governed by service classification, requiring mandatory transparency, quality enhancement, and uncompromising alignment with client interests.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Listen also to the French edition of the Luxembourg Fundcast.
Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn. Read the full analysis of the podcasts at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.